Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. First episode for F23.
Yes, true.
Happy New Year.
Yes, what a party and celebration we had.
We always talk about we should do something for end of financial year or like start of financial year.
We do.
But it's just like...
We never do.
Like you do your tax and you move on with your life.
Yes.
Back in the corporate world, there was a bit more going on, but here at Equity Mates, it's just another day.
Yeah, too much stuff going on. But happy financial year, new financial year to those out there that do celebrate it a little bit more than we do here at Equity Mates. But Ren,
I might start taking it as a holiday.
no, you try and sneak in so many holidays. But Ren, a big show today. So we're going to start off with a market update and try and answer the question, is inflation over? Very provocative start. Macquarie have released 16 stocks that they classify to be a recession-proof portfolio. So we'll check in on that. Bridgewater, always... can't have an episode without talking about Bridgewater Associates.
We've had the majority of our episodes, we haven't spoken about them.
I had a look at some of their top holdings, and there's a bit of a what the moment.
Let's just say that even the best investors make common mistakes.
Yeah, so I'm going to we're going to chat through that and then close out with the conversation around the Widowmaker trade. And if you don't know what that is, stay tuned. But Ren, before we jump in, we've launched another thing here at Equity Mates Media.
I know. In case we didn't spend enough time looking at our phones already, we have launched a new Instagram account. The Dive, the new podcast that we've been doing, talking about business news. If Equity Mates is all about investing, The Dive is a little bit broader. It's about the world of business. We've created an Instagram account to go with it, thedive.businessnews. Go and check it out. We are sharing news stories from around the globe, making them hopefully digestible and accessible. Check it out, thedive.businessnews.
That's it. Multiple news stories a day from around the world.
Yeah, we'll keep you up to date with with what's going on in the world, with what we can keep up with in the world.
Yeah, what we can keep up with. Some of the different business headlines that you might not see on the front page of the AFR, or we're trying to show everyone the excitement that business news is. Yeah,
it's exciting, it's interesting, but the other point of frustration for us has been that so much business news is short term.
Yeah.
You could take a red pen to the AFR or to the Wall Street Journal, to the Financial Times. Financial Times is actually pretty good.
Yeah, it is good, yeah.
And just cut 2/3 of the stories out and say, this isn't going to matter next week.
Yeah.
And that's frustrating. And I think that turns a lot of people off. And so we want to really focus on that remaining third of stories. And I've just pulled that third out of thin air. But those stories that do matter and that we can really learn things from long term. So it's a big mission. We're trying to figure it out.
We are. So check it out, thedive.businessnews. If you're also not subscribed to the podcast, jump on to your podcast player and subscribe to The Dive as well. So Ren, is inflation over? Bit of a market update because obviously we're through. The last couple of months, inflation has been roaring. We've seen multiple interest rate rises from central banks around the world.
Inflation has been the word of 2022.
Absolutely. And there is some indicators that you could argue might lead to some suggestions that inflation is over.
Well, Bryce, you know I'm a fashionista at heart. If I wasn't doing an investing show, I would probably be doing a fashion YouTube. And I am...
Couldn't agree more.
I am very closely watching the raw input costs that go into the fashion world.
Yes.
You've been watching the price of cotton?
I have actually.
There you go. So cotton got rug pulled this month.
Did it?
It collapsed. I mean, the price of cotton is a commodity that's traded, and it just dropped. It's down like 30% in a bit over a month. But in June, it just straight down. off a cliff. Yeah.
Wow. What led to that?
Inflation's over. Well, no, I think this is a broader trend we're seeing in a number of commodities. The last sort of month, or from sort of early May, we've seen commodities fall. And in an inflationary environment, you would say commodity prices should rise because the value of money is less. And if commodities hold their value, they will go up. And that's sort of what we saw. We saw oil and natural gas go up because of Russia's invasion of Ukraine and all of that. But we've seen across the board, commodities have been really strong in 2022. Coal, iron ore, all the agricultural commodities. But they're softening. Oil down 7% in the last month. Coal down 5% in the last month. Copper down 13% in the last month. Iron ore down 9% in the last month. What's going on?
Yeah, well, it's interesting. My key takeaway from this, though, is that this can all change pretty quickly, particularly oil. And I feel that all it takes is for expectation again to be missed. And so what I'm feeling is happening at the moment, I'm sensing that the expectation for our inflation numbers is going to be softer, and all it's going to take is for the inflation numbers to be higher than expectation, and bang, we're back to 3-4% drops on the market overnight and those sorts of things. So I guess you could say that the flow-on effect for natural gas down 20%, oil particularly is a big input. That's probably the key one.
I think I actually skipped natural gas there. We should make that clear. Natural gas down 26% in the last month.
Yeah, pretty significant. But for me, oil is the big one. A lot goes into the oil price. Well, I mean, a lot of time and energy from analysts go into the oil price, given the implications it has across so many businesses. And then we know an interesting chart that our comedian v Economist boys Thomas posted this week to show the relationship between oil price and the NASDAQ. When oil is down, NASDAQ is up, and vice versa. So I think he called the bottom.
Now, I think you said the really important thing there, which was expectations. So I don't think it's a coincidence that early May, when some of these commodity prices started to soften, was around the same time that central banks' rhetoric and action started to harden. So if we think back to May, what did we see? We saw a 50 basis point rate increase in the US. We saw rate increases in Australia. In June, we've seen rate increases everywhere as well. Mostly everywhere, not Japan. We'll get to that later. And I think people, and alongside that, we've seen the central bankers, one, say that they were wrong about inflation being transitory, and two, get pretty aggressive in what they are saying. The big three, the European Central Bank, Christine Lagarde, Jay Powell, the Fed Reserve Chair, and I'm going to forget the third guy, the Bank of England Governor.
Can't remember.
Andrew Bailey. Don't know where I got Mark from. The three of them spoke at a conference last night when we were recording this, and basically all of them said the same thing. The end of moderate inflation, the era of moderate inflation and low interest rates is over, and we need to take drastic action to break the back of inflation. And I think the market's seeing their actions and hearing them, and that's probably why commodity prices across the board are softening a little. Yeah.
Speaking of central banks, I just have no... This is going to sound stupid, but I have no time for the RBA. Honestly.
I'm here for the RBA equity mates beef.
They've just got it. They've just got it so wrong all the time. They just get it so wrong.
Yeah.
I just don't understand.
Do you reckon you could do a better job?
No. Well, I don't know what goes on behind closed doors, but if all they're doing is one meeting a month to determine what happens with rates. But I don't know. I just don't. They just get it so wrong, and so every single time.
Yeah.
I don't feel like they've ever front run anything to truly. And I could be wrong here. Like I don't have decades of experience.
No,
but
I think you're right, and I think
far too reactive.
I feel like so. Jay Powell has come out and basically said we had no idea, and I think Philip Lowe?
Yeah, Philip Lowe. Yeah.
I think he said the same thing as well, didn't he?
Yeah, but it's in
Didn't he
hindsight.
Didn't he get grilled in like an interview with Lee Sales recently?
I think so, yeah.
Yeah.
But I mean, he was saying, no rates until 2024, blah, blah, blah. Like, what an absolute boo-boo.
Like,
so,
and I mean, like, we talk about it academically, like they don't get it right. But like a lot of people took that as a commitment and borrowed on the back of
the
it.
The implications of that.
Like, it's actually really not great.
It's pretty significant, And they know that their commentary has serious implications for how people make investment decisions.
Yeah.
So getting it so wrong for me. It's and then they come out with commentary around, now might see inflation softening, those sorts of things. You all got to take it with a grain of salt.
Yeah. So we'll park that until we get Philip Lowe on the show.
Good point.
But I was flicking through commodity prices before this episode to have a look. Some of the commodities that are traded are pretty fascinating.
Okay.
What do you reckon orange juice? Not oranges, orange juice.
I didn't know that was a commodity.
Neither. What do you reckon it's done in the last month?
Skyrocketed.
Nah, up 1%, but up 50% year on year.
Wow.
Yeah.
Does that correlate with the price of oranges?
Couldn't tell you. I can't actually see an oranges one here. Price of potatoes have absolutely tanked in the past month, down 38%.
Okay.
I wonder if Macca's will pass that cost saving on to us.
Nope.
Sunflower oil down 21%. That's actually a really important one because the Ukraine is a major global supplier of sunflower oil. And on the dive, actually, we did an episode talking about how a third of UK fish and chips shops might have to close. And part of it because they couldn't get cooking oil or cheap cooking oil. So it's good to see that price has come down. Canola has also come down. Cotton we spoke about. Palm oil, wheat down 16% in the last month. I mean, there some commodities are up, but generally things are down, which is good to see.
Yeah, nice.
Yeah, tea up, probably to do with Sri Lanka.
Okay.
Yeah. Because have you seen what's going on over there?
No.
With their so they're obviously in this economic crisis, but now they're rationing fuel to such an extent that people can't get any.
Yeah,
it's
right.
at that point now.
Wow.
So it's almost like a de facto lockdown because people just can't get fuel.
Because they can't go anywhere.
Yeah,
Holy
it's pretty
smokes.
devastating. Yeah.
Well, speaking of prices down, Ren, just to close out this segment, you'd remember when we were doing our Ausbiz channel late last year, there were a couple of, lumber was one that went skyrocketing. So there was a Bloomberg article that kind of recapped on some of the, some of the products or goods and services that skyrocketed late last year and where they're at now. So trucking, we know, absolutely went ballistic in the second half of 2020 into 2021. Trucking, the price of trucking per mile or per kilometre is drastically dropping in 2022.
Yeah.
Shipping rates have come right back,
Okay.
which was, I remember that was a massive concern during COVID. Shipping rates were through the roof. Lumber has, I wouldn't say fallen off a cliff, but it's down from about 1,200 and whatever it was from memory per, what is lumber sold in? Ton?
Nah,
per meter squared?
It would be
per
some
log?
Bespoke
Per
here you go. US dollars per 1,000 board feet.
there you go, yeah. So it's down from about 1,200 back to about 500. So significantly down. And Rolexes have really chilled as well.
Really?
Yeah.
I used to work with a guy that collected Rolexes and I just didn't pay it at all.
Fair call. So look, I guess the takeaway here is watch this space. We know we're going to have an update coming soon on inflation numbers, and there's always, of course, a monthly meeting between central banks as they determine what to do. So, watch this space, I guess.
Yeah.
Moving on. So, Ren.
Well, I think just to answer the question that we started with, we asked, is inflation over? I don't think we can say it's over.
No, I don't
Commodity
think so.
prices are falling, but a lot of the issues are still there.
Yeah, absolutely. So Ren, moving on, Macquarie have released some research done around some stocks that perform or sectors that generally perform well during a recession, and they've created a 16-stock recession-proof portfolio.
Yes,
Now,
yes.
this is Macquarie.
Yeah, not us.
Not us. This is
We
Macquarie.
will be. It's an interesting list. It's all ASX. But before we get into that, there was some interesting findings from previous recessions.
Yeah, so they kind of split recessions, and I think we caveat this by saying there's some conversation around the States going to recession, will Australia, TBC, but the recession word is certainly out there, which is why they've done this. And the Macquarie analysts split recessions into two parts, and the first part is obviously that contraction phase where economic growth really slows down, and if we're to be technical, a recession is 2 consecutive quarters of negative GDP growth. I don't think Australia has had their first quarter of negative GDP growth at the moment. The States, I think, have just. But they had a look at the sectors that perform well in this sort of contraction phase. So the best sectors are staples and utilities. They outperformed 13 of the past 15 times we've gone into recession.
And give us an example of each.
Staples, Woolworths, Coles. Utilities is your power, power stations.
Like your AGLs and your Origins, yeah.
Transurban.
Nah, that would
That's
be
infrastructure.
Yeah.
Health and telecom outperformed 12 out of 15 times, and then gold outperformed 5 out of 8 cases, and it has the second highest average return during a contraction phase of a recession. Whether or not that's playing out at the moment, though.
I think it's holding up okay. It was digital gold, not so much, but
No, digital gold, definitely not. But health with, CSL, for example, telecom, Telstra, and gold is gold. On the other end of the spectrum, though, Ren, industries to perhaps be very careful of in the contraction phase of a recession are industrials. They have never outperformed, and diversified financials and basic materials have only outperformed 2 of 15 times. So there are sectors that I guess don't respond well to a contraction in GDP.
And you think about the mechanisms there, like that isn't surprising that like basic materials like commodity producers and stuff like that, and industrials that are tied to like the overall output of the economy, like that's not surprising that they don't perform well when there's less spending and less economic activity. And diversified financials, like a lot of them are correlated to
Spending.
the stock market. Well, also the stock market.
So so that then leads to the next question, Ren, around, well, what are they actually putting into these?
Yeah, this is the interesting thing.
So
you gave us a few buckets there: consumer staples, utilities, healthcare, telecom, and gold.
Yeah.
Now, Macquarie haven't quite followed their own buckets in this, but they broadly have.
Yeah.
So let's start with consumer staples.
So they have 3 stocks in consumer staples, all very well known.
And one notable omission, I must add.
They probably just wanted to give these some airtime.
Oh, yeah, okay. Well, tell us what they got.
So they've got the only stock in there is Woolworths. No, I'm kidding. They don't have Woolworths in there, surprisingly. Coles Group, Endeavour, which spin off from Woolworths, and Metcash. So Coles, we know, is one of Australia's largest retailers. Endeavour Group, they own BWS, Dan Murphy's, and ALH, the largest owner of hotels and pubs in Australia. And Metcash is IGA.
Yeah, the IGA supply chain.
Banner. Yeah.
Yeah. Because then like IGA's are...
Yeah, franchise.
and
Yeah,
stuff like
so they feed into IGA. So they've gone heavy on retail, obviously, because it's consumer staples. Yes, they have left out Woolworths. Not sure why, but I think when I think about recession, these are the companies that always come to mind first, because people always need to buy food.
Yeah.
So they're going to stick around. What are your thoughts?
I mean, it's a pretty unsurprising list. I don't have a lot of thoughts, to be honest. I had a look. So we love Ticker here, TIKR, and I just was having a bit of a look at some of these companies on ticker and see what I could find. I was actually trying to see if Macquarie hold them, and you can actually see all the major ownerships. But there's so many, and all the ETF providers and Vanguard and JP Morgan. So Macquarie do own some of them, but then it's like, do they own them for clients?
Yeah.
But it's funny, like there's a bunch of stuff you can see in here. You can see when insiders bought. So for Coles, Stephen Kane, the CEO, dropped about $1.5 million on
Nice.
Coles shares in August last year.
Nice. Good sign.
Not a good time,
Not a great time.
but
Pick this-
Coles has actually held up okay. He's not down too much from August last year. But yeah, I mean, look, those three companies for me are pretty standard.
Yeah. If you're investing with, well, depending on what your ESG lens is, you mightn't be too happy to see Endeavour Group in there, because they obviously are the operator of probably the biggest group of pokies in Australia now.
Yeah.
So, Infrastructure, Ren, was the next bucket that Macquarie came with. So 4 stocks here: Transurban, Origin Energy, Amcor, and Aurora. So Transurban are the operator of toll roads here in Australia. Origin Energy, we know, is Origin Energy. Amcor is
Packaging.
packaging.
Yeah.
Yeah, that's right. And Aurora is
Similar packaging.
is it packaging?
Yeah.
Yeah. Okay.
So Macquarie obviously bullish on the packaging industry.
Yeah. I wonder what it is that makes that sort of recession-proof.
Well, I think like the same logic that applies to consumer staples. The reason that Coles and Metcash and Endeavour hold up is because people need to keep buying food, and for those companies to get the food,
It needs to be packaged.
it's packaged. So it's Visy, Aurora, Amcor, and then it's pallets as well.
Don't get me started on pallets.
Transurban, not surprising. Transurban is the quintessential. It's like the economic textbook example of an inflation hedge. It's like, ability to raise prices and inelastic demand and all of that. So not surprising that any of them are on there. But again, like, not a lot to say. There is a really interesting story around Origin and the energy transition. And that's probably a whole other overlay that you have to put over any company involved in energy in Australia at the moment. But I don't think it's surprising that Macquarie put Origin and not AGL.
I was just going to say, yeah, Origin v AGL. That makes sense. So, consumer staples, infrastructure. Their third was healthcare. So they have 3 stocks in healthcare. CSL, mind you, these are all Australian stocks, we should say. CSL, Ramsay Healthcare, and ResMed. 3 pretty well-known Australian healthcare stocks. Now, they've decided for their gold exposure to go with 2...
Yeah, and just quickly on Ramsay, it may not be listed for long because KKR are trying to buy it. But, yeah.
Yeah. For their gold exposure, they've gone with gold miners Newcrest Mining and Northern Star.
Yeah.
And then food, and I think this is more actual food production rather than sale of food, but they've gone for Grain Corp, United Malt Group, Elders, and Costa Group. United Malt Corp.
United Malt Group.
What are they? They are brewers and distillers in North America.
Yeah.
Wow, there you go. Well, they serve the evolving demands of brewers and distillers in North America. There you go. So,
the production, sale, and distribution of bagged malt, hops, yeast, and adjuncts.
there you go.
Yeah.
Wow.
So basically what I'm taking from this list is that Macquarie are pretty bullish on 2 things holding up. The demand for alcohol, and you've got like United Malt Group leading into an Endeavour Group, or leading into an Aurora and an Amcor to package it and box it up, leading into an Endeavour or a Coles to sell it.
Yeah.
And so demand for alcohol and then demand for food. And
Yeah.
that's where you've got like a Grain Corp, or you got Elders with the land, and then you got like Costa Group and Grain Corp, or Costa Group growing the thing, Grain Corp trading the thing, and then packaging it up in an Amcor and in an Aurora, and then selling it at a Coles or an IGA.
And then a side dish of healthcare because everyone still needs that as well.
Because if you eat too much and you drink too much, then you need healthcare.
Yeah, that's the type of analysis that goes into building a portfolio. But anyway, there are 16 stocks aligned with the sectors that they've done some analysis on that shows, I guess, outperformance in times of a contraction. Now, I guess keep in mind as well that we're not in a recession at the moment, but that's just some analysis they did to show what might happen.
And just keep in mind that so many of these lists published seem to anchor to large cap stocks.
Yeah. It's the ASX 20 there.
Well, this is at
Without
least a few different names. Yeah, the notable omissions are things like no banks or financials and stuff like that. But Livewire published a list of top 20 inflation hedges, and we put it up on our Instagram because I just thought it was so funny. The top 5. See if this rings a bell. BHP, CSL, Macquarie, Woodside, Commonwealth Bank.
It's the top 5.
It's like the 5 biggest companies. Like obviously Macquarie isn't in the top 5, but like it's just the biggest company.
That's so boring. Anyway, so that's the 16 stocks from Macquarie. It is worth mentioning, and this is something that we've spoken about over the last couple of weeks, or at least nodded to. They have suggested that the biggest thing they're keeping an eye on at the moment is actually corporate earnings, because we all know what happens when corporate earnings downgrades start to come in, and when those also when those downgrades are more than expectations. And so with everything that's going on with inflation at the moment, and I guess broader macroeconomics, we might start to see downgrade on balance sheets and those sorts of things. So
July will be the moment, because we'll start getting American Q2 earnings this month, and then it's also confession season in Australia, because we probably won't get earnings until August in Australia.
Yeah.
But if companies need to downgrade their forecast, they'll do it in July. So this month
hold on to your seat.
This month we'll learn a lot. And some of the numbers, so for example, Bed Bath & Beyond reported, when this is out last week, but yesterday as we're talking, sales down 25%.
Wow.
Big box retailer in the States. And is that a sign of consumer weakness, like weakness on the consumer balance sheet? Bed Bath & Beyond is like homewares and stuff like that, very much consumer discretionary. You stop buying new towels before you stop buying food.
Yeah.
Or is that just a poorly run business that is struggling?
No.
So it's probably Bed Bath & Beyond in particular is a poorly run business. So that probably isn't a great indication. But like Walmart, Target, Amazon, they're all to come. Yeah.
We'll definitely see it. I feel like it's going to be easily a 2 or 3 or 4 month lag, for consumer confidence is now getting pretty bad. That's just going to start flowing into these consumer discretionary stocks.
It's just so funny, because do you remember at the start of the year, everyone was like, the consumer balance sheet has never been stronger. People have saved so much during the last 2 years, and there's all this pent-up demand, all this pent-up savings, and we're good. And then things turn really quickly. And obviously, there are reasons why that has happened. Energy prices are so high, food prices are rising, general inflation across
Mortgages.
the economy, higher interest rates, that all weakens the consumer balance sheet. But it is just fun. It's a real reminder that you got to take the day-to-day news headlines with a grain of salt, because if you had invested on the back of the consumer balance sheet has never been stronger, you would have piled into the consumer discretionary stocks thinking that there's a lot of pent-up demand that's going to be released.
It might still be true, but the confidence for them to now deploy that and put it into that consumer discretionary stuff rather than say I should hold on to this because things are tough. So Ren, just very briefly, had a bit of a what the moment when I was that's right, I was doing a social post and I saw that Bridgewater Associates,
Yes.
Ray Dalio's
World's biggest hedge fund.
Yes.
About 160 billion assets under management.
massive.
Ray Dalio.
Ray Dalio is up 26% this year.
Not bad.
Not bad. Pretty phenomenal. Up 26%. I guess that's what the purpose of a hedge fund is, to be able to hedge performance.
Hedge risk, yeah.
Hedge risk. Not related to this performance because you actually don't get insight into a lot of the stuff that they're doing behind closed doors. They don't make it publicly available. But I did have a look at some of the 13 Fs or the filings for public disclosure for what they are buying and selling in some of their bigger portfolios. And it was surprising. I remember maybe a year or so ago, we did the same exercise, and some of his largest holdings were the S&P 500,
Yep.
the NASDAQ,
Yep.
some of the biggest indexes in the world.
Keeping in mind that 13 Fs, you only have to report on American holdings.
Yep.
So there's, it's not a complete list of everything that Bridgewater owns. We could do the maths. I don't know if you got it in front of you, but we know they've got about 160 billion assets under management.
Oh, it's definitely not all reflected in the 13 Fs.
Okay.
Yeah.
But in saying that, what we do see paints an interesting picture still.
Yeah, well, that the dynamic has changed. He still does hold a couple of the S&P 500s and whatnot, but 3 out of the 4 top holdings are disclosed. Roughly 10% of the portfolio are now emerging market exposure, which is firstly a bit of a what the.
Yeah.
But secondly, the more surprising thing was that it's done in 3 indexes: Vanguard Emerging Markets Stock Index, the iShares Core MSCI Emerging Markets, and the iShares MSCI Emerging Markets ETF, both of which feel like they should just be the same ETF. So I'm not really sure what's going on there. But I guess what the moment is has this guy ever heard of ETF Overlap, and why doesn't he just buy the one ETF, honestly?
Yeah.
But pretty surprising that, well, I don't know if it's surprising, but I was interested to see that he's going hard on emerging markets.
Yeah, I wonder what the difference is between the iShares MSCI Emerging Markets and iShares Core MSCI Emerging Markets.
Yeah, probably just the exposure to
Maybe like
country.
or the concentration of it.
Yeah, but also just like, mate, have a look under the hood. Just buy one.
All right, well, here's the question. So 3 emerging market ETFs, the Vanguard one and then 2 iShares ones. Do they have the same top holding?
No.
No, you say?
No, I say.
Well, they do. They all have the same. Do you want to guess what it is? Emerging market company. It's one that we've definitely spoken about on the show before.
Is it a Chinese stock?
It's not.
Is that an emerging market?
It is for the purposes of these ETFs.
It's an Indonesian stock.
It's definitely not an Indonesian stock.
I don't know. Tell me.
I'll give you the country. You'll guess it straight away. Taiwan.
Semiconductors.
Yeah. TSMC. Number 1 in all 3. About 5% of each portfolio, or 6% of one. Next 2 are the same, but in different orders. Oh, no, sorry, in the same order in each of them. Do you want to guess them?
No.
Okay. So top, Taiwan Semiconductor. Second on all of them, Tencent.
Yep.
Third on all of them, Alibaba. And and then it moves a little bit. Then Samsung is up there. Also, Reliance Industries, that massive Indian conglomerate. Meituan, the Chinese Uber Eats, is also up there. They're sort of the top 6.
Okay, this kind of is starting to make sense because he's very bullish on China.
Yeah.
And I guess, so he's a macro investor. For those who are unsure, macro investor has released a lot commentary over the last couple of years on the changing evolution of geopolitics at the moment and the change of the guard between US and China, and I now it sort of starts to make sense why he's going so hard on at least the top 10% of his portfolio is exposure to those big companies. So that makes sense.
The really interesting thing, so I'm just flicking through these lists now. Really interesting thing, and this is a good reminder to always look under the hood. South Korea. The question of should South Korea be in the emerging markets index? Well, Vanguard have obviously answered that to the negative because Samsung just isn't in this holding. But BlackRock or iShares have decided that South Korea should be in the emerging market classification because Samsung is in both of their ETFs that we're looking at. So even if something says it's got the same label, emerging markets, it always pays to look under the hood. There's some fascinating companies in here. Like, we could go down a deep rabbit hole, so let's not. But like talking about Vale in Brazil anyway. So interesting, but yeah, I agree. ETF Overlap.
ETF Overlap. Yeah. Honestly, Ray, come on. Needs to learn a thing or two.
I guess the thing is, you're paying more brokerage because you've got to trade multiple positions. But
does Ray pay brokerage?
Yeah. Bridgewater would probably keep a few brokerage houses in business.
Yeah, for sure.
But, the complexity of managing multiple positions, Bridgewater can probably manage it.
Yeah.
All right. Mindful of the time.
Yes.
Let's get on to the Widowmaker trade, a term that is used to talk about Japan.
Okay.
And I think it's worth talking about Japan because we're talking about inflation, we're talking about interest rates, but there's one country bucking the trend around the world, and that is Japan. So the Widowmaker trade is a trade that has broken a number of big investors over their time. They get enticed by the idea that Japan is going to default on its debt, or that Japan, and that because of that, Japanese bond prices will fall. They look at debt to GDP, they look at the demographics of Japan, they look at the economic growth, they just look at Japan and they say,
it's got to happen.
It's got to happen.
Yeah.
Bond prices can't stay high, so I'm going to go short Japanese bonds. But what has always happened is that even as Japanese debt grows and grows, bond prices don't fall. And that's largely because the Japanese central bank is very active. And we'll get to that in a second. But some of the best investors of our time have lost their shirt on the Japan trade, the Widowmaker trade. David Einhorn, who also lost his shirt shorting Tesla.
Yes.
In 2009 said Japan's debt burden would lead to a government default, shorted Japanese bonds. Was unsuccessful.
Yes.
Kyle Bass, who's another big investor, predicted that the Japanese government bond market would collapse. He was wrong. David Roche, someone I haven't heard of, but he predicted a surge in Japanese yields, and if yields are going up, bond prices are going down. Never came to pass. Because so many investors kept making the same trade and kept losing money on it, it got labelled the Widowmaker trade.
I don't mind it.
Yeah, it's pretty funny. And now with inflation high around the world, a number of investors are getting back into that trade. 2022 is a year for this short Japanese bond trade. And interestingly, so around the world, we spoke about it earlier, central banks are raising interest rates, except the Bank of Japan. They have a view that cost push inflation is temporary, but also that higher interest rates aren't going to really break the back of inflation because it's cost push. It's food prices, it's energy prices from events around the world rather than demand pull.
I have time for the Central Bank of Japan.
Yeah, same. I tend to agree. The idea, the counter argument though, is that if you raise interest rates, you can still break the back of cost push inflation by demand destruction. Yeah. But inflation right now is 2.5% in Japan. And similar to the rest of the world, the 2010s, they were desperate to get inflation in the system and they just couldn't. But yeah, 2.5% in Japan. But they're still keeping rates near zero. And the Bank of Japan they control the yield curve on their bonds, and they cap their 10-year government bond at 0.25%. And so investors are piling into this trade thinking that they can't keep that cap, that's not going to last, and they're going to be forced to raise rates and take that cap off at some point, which will see bond yields increase and bond prices fall as a result. So that's the situation. That's the trade, the Widowmaker trade. The setup is there.
Fascinating.
The variable is the Bank of Japan, and this is the fascinating thing, I reckon, because they will do anything, and I mean anything, to protect their market.
Yeah.
So the Bank of Japan has bought so many Japanese government bonds that they now own 50% of all Japanese government debt.
Wow.
Yeah. Which is a little bit of like left hand...
Yeah.
Like taking from left hand to pay right. I don't know what the analogy is. But like what's the end? Like, could a central bank just keep printing money and own 100% of government debt? Like, surely not.
Yeah, surely not. Maybe in theory.
I don't know. Like, are we going to see that in Japan? Because, like, the other thing is the yen is dumping. Like, no one wants to own yen because if an American government bond will pay you 2%, why would you own a Japanese government bond that pays you 0.2%?
Yeah.
So everyone's getting out of Japan and into
the US.
Other currencies, other government bonds and stuff like that. So the currency is also collapsing. I don't know. It's strange.
The story, but I think history shows itself. So how far back? David Einhorn, 2009.
Yeah. Well,
so 13 years ago. This is the story, and the story probably goes back before him.
Then. Yeah. So they buy government bonds.
I just feel like the Japanese are, they'll just stick to it.
Yeah. Well, so 50% of all government bonds are owned by their central bank.
Yeah.
Also, between 2010 and 2021, the Japanese government spent about $500 billion US buying stock market ETFs.
Yeah, I remember seeing a couple of years ago the stat about how much of the stock market
Japanese
they own.
stock market.
How much of the Japanese stock market they own on their balance sheet, and it was an extraordinary amount.
Yeah.
Just propping up.
I know. It's crazy. It is unbelievable. Now they apparently pivoted that policy a little bit last year, and they're not buying one index, they're buying another index, or they're buying less or something like that. But yeah, they're still buying a lot of bonds.
I mean, they're consistent, then they're sticking to their message and they're staying true to their strategy.
Yeah. So it's just like, this is probably not super relevant for us. Like, I'm not long or short Japan, but I am fascinated to watch this play out. That a trade that hasn't worked for over a decade the setup is there again, and investors are moving into it.
Yeah.
And I think it's just one to watch and one to be aware of. And it'll be interesting because if the Bank of Japan are right, that probably says something to other central banks around the world.
Yeah, have a look at yourselves, honestly.
But I wanted to...
The other thing as well is just 2.5% inflation in Japan's pretty incredible.
Yeah, you mean low?
Yeah, so even though they're experiencing cost push inflation... they're obviously not as reliant on a lot of external...
No, I think it might be an indicator of how things are going. You know, even with price rises, like consumption's probably going down and stuff like that as the population gets older and there's less people working and stuff like that. Maybe people save a lot more, so rather that the demand destruction might happen a lot quicker in Japan. I actually haven't looked into it. You're right.
I wonder what their target rate is then.
2%.
Oh, it is.
Yeah.
Oh, so that's cruising. Anyway.
No, but the thing is, there's different ways to get to 2%, and I think the way that they want to get to 2% is from increased consumption, which fuels economic growth, whereas getting to 2% this way is not fueling economic growth. Yeah. But I had a look at... We've got a bit of a gripe with some financial media, as we've made clear in this episode and previous episodes. I googled the Widowmaker trade is back because that was the AFR article that sparked this segment.
Yeah.
I see they published it, I think, earlier this week, or when you're listening to this last week. And so I just googling, just looking at first page or two of results. In 2010, a CNBC article, Widowmaker trade is back. 2012, Business Insider, same thing. 2013, Investment Week, same thing. 2015, Sydney Morning Herald, same thing. 2019, Financial Times, same thing. 2020, Bloomberg, Widowmaker trade is back. And then 2022, AFR.
It's almost as if the editors are like, well, it's that time of year again.
Yeah. It obviously gets some good clicks, but it's a fascinating trade.
Yeah.
But
will the Bank of Japan have made the right decision and the right call?
I think the point is people have called this shot before. Media,
failed.
expert investors.
Yeah.
And no one's been right.
No.
But
will
maybe
this time be different?
Maybe this time is different.
Is different.
The broader macro environment feels a bit different.
Yeah, but I mean, they've called it a lot of times. Nice one to finish on, Ren. A quick reminder that if you haven't jumped in and bought your tickets to FinFest, Australia's largest finance festival that we are launching in October here in Sydney, 15th of October, make sure you head to equitymates.com/FinFest to grab your ticket. They are only $47, less than half the price of your average summer music festival, but it's going to have the same vibe, the same atmosphere, plenty of experts being flown in from around the country to help you on your investing journey, along with entertainment, food, bit of beer, bit of booze. It's going to be a great day.
Less than half the price of your average summer festival, and I guarantee at least double the amount of investing chat.
at least, depending on what you and your friends talk about at summer festivals. But Ren, it's been great to chat. Plenty of stuff going on in markets. We cover a lot across the Equity Mates media network as well. Make sure you go and check out all of our other shows. We've got The Dive, which we've spoken about, which is our daily news show. We are relaunching Get Started Investing as well. It's taking a hiatus this week as we come back with a new format, so stay tuned for that if you're listening to Get Started Investing. But we've got Crypto Curious, Talk Money to Me, You're in Good Company, and CVE, Comedian v Economist, all covering everything that's going on in markets at the moment. But Ren, always great to chat. We'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.